What is up, Wyze traders? I just want to go over a quick supply and demand video. This video is going to be the basics of supply and demand, which a lot of people are asking me. And I've given out PDFs before, but it's a lot easier to see someone do it and talk about it. So with that being said, let's hop right into it. Before the actual aspect of supply and demand, I want you guys to understand some hard truths. You'll never buy the absolute bottom or sell the absolute top. You're looking for a small piece of the move. Trying to catch the exact top or bottom leads to overtrading, frustration, trying to catch the knife when it's falling, and getting run over the train when it's going high. So we are looking on historical moves where the market tends to come back to and repeat. Along with this, trading is 20% skill and 80% emotions. If a lot of you have been following me for a while, you understand that I always say this. It's very, very easy to understand technical analysis after a couple months, but you will always end up fighting your emotions every single day you're in a trade. Once you start to master your trading psychology, the technical side becomes even easier. Number 3, which is a big controversy, is the market is designed to take money from retail traders. The institutions move the market. People like me and you, they do not move the market. They know where people are going to end up taking trades. They know where pain is going to be made, and then they end up making gain on the other side. Another theory that I go over very, very often. Second here is the market changes constantly. We must slowly adapt. What worked last month exactly to the tick might not work this month. We constantly shift between trending, ranging, and volatile environments. Taking small steps and adapting is what separates consistently profitable traders from one-hit wonders. And number 5, which everyone hates the most, all traders lose. This is where we learn. Consider your tuition. Every losing trade carries a lesson with it. You need to journal this, review it, and be honest with yourself and if your edge is still present in the market. So having an auction theory to the market is where the basics of supply and demand is. Understanding this concept is going to change your brain and how you look at the market. You're going to learn how to identify imbalances between buyers and sellers. You're going to mark the zones, and you're going to use them as exits and entries to then put small risk in the market, looking for big gains. The whole theory of supply and demand is trading with the institutions, trading with the banks, and the big volume. This is where they place massive orders that cannot be filled in a single pass, and the price tends to return to that original zone, giving the remaining orders an execution and then moving the market back in the same direction. The theory of supply and demand doesn't just apply to any stock, it applies to futures, forex, cryptos, commodities. This happens from airplane tickets to sneakers, to everything else being sold and bought in the world. An outplace of supply, the price rises, and when supply floods the market, price falls. When demand increases and supply stays the same or decreases, a shortage of the product occurs and price then moves higher. You have to think of this as something that's selling out everywhere. Like I said, you can generally speak about sneakers, something on Amazon, anything on any market. When there's a scarcity and someone wants it, they're naturally going to pay more to have it. So this is the overwhelming force driving stocks or futures higher when buyers overwhelm seller at a specific price levels. So this is the big force in the market driving the stock or future higher when buyers overwhelm sellers at a specific price level. Now we're going to have the result of a surplus. When demand decreases and supply stays the same, you're going to get a fall in the market. Anything that's showing that there's going to be more sellers in the market than buyers, whether demand decreases or supply increases or both, you're going to have the price move lower. This is a product or a stock or a future that is no longer wanting to be bought at that price, and sellers are overwhelming buyers, flooding the market. It's going to naturally lose value and get sold for less. Again, the core concept of this is supply and demand controls the world. The sooner you understand the foundation of everything, from the price of groceries to movements of billion-dollar indexes, the sooner you understand the power of the simplicity of this trading style. The less complex you get with it, the better it is. Okay, so now we're going to learn how to draw a demand zone. We're always going to scan from left to right, and we're going to start on a higher time frame. So for something like this, we're on a higher time frame. We're on a 4-hour time chart right here. And for something like this, we're going to start from left to right. Okay, so my first areas of interest is not going to be this because the market came down underneath here, breaking that demand zone if there was one there. So we're going to be looking at this zone in here and also in here if we can find something. So to just make it easier for myself, I'm going to mark these both down. And now I'm going to shorten the time frame down to get some more details. We'll start here. Like I said, we're starting from left to right and see what we can make in this zone. So over here with more detail, I can also see a wick down here. So I'm also going to mark this down. I'm going to come to the left a little more again. As you can see on a 4 hour, there was no wick there. The wick started here. This is key details why you need to start at a higher time frame and always work your way down. So we're going to go to a 3 hour again, and we're going to mark this zone down. Now I'm just going to keep on moving down in time frames and seeing what changes in details and where I can mark a good size zone here. Nothing on a 2 hour, we're going to go down to a 90 minute. Nothing here again, and we're just going to keep on working our way down. A 1 hour now. In a 1 hour, I see a nice basin candle here. So I'm going to extend and come in here. So now what do I see in the market? I see a nice rally. I see a halt in the market, right? A basin candle, which is the key component that we need for drawing a demand zone. And then I see a nice rally, right? This also has New York volume. I need to see volume when drawing a demand or a supply zone. For example, over here we have 2,400 orders, 3,400 orders, and then 2,800 orders, right? Now we come into here and we have 36,000 orders, 27,000 orders, and 34,000 orders. There's a lot more volume here than there is here. This is where the institutions are trading, this is where they're putting their orders, and this is what's moving the market. So now on this 1 hour, I'm going to draw the lowest wick here, which is going to be the basin candle, the red candle in here. And I'm going to take that wick and I'm going to engulf the body of the basin candle. Okay. Again, we're going to go through this one more time. The lowest wick, not this one. We need this wick in here. And we're going to engulf the body of the basin candle. It's always two candles together. It will not be this candle. And it's not going to be wick to wick. It's not going to be here. You need the body of the basin candle. This is now our 1 hour demand zone. So again, right here, I said you have to go left to right, and this is exactly why. You might try to draw a zone on this wick in here, on this movement up, which would then be valid, right? We have volume, we have movement, but the true zone is here. This is where you're looking for, not here. So I'm going to mark this out now. That is no longer interest because we have our actual demand zone in here. And now we have a 1 hour demand zone. Again, I'm going to draw it one more time so no one makes mistakes here. We're going to get the lowest wick of the two, right? We have a rally, a base. This is a consolidation. This is where volume is accumulating, and then a push up. So now we have a 1 hour demand zone. If you drew this day, you could have took two very, very good plays off of it, one overnight and one during New York session midday, giving you a massive rally and some massive points of over 200 points on NQ. So this is our 1 hour demand. So following this, we scanned from left to right. We found our major move up from the first basin candle. We started on a higher time frame and we worked our way down, exactly how we needed to do. We identified the basin candle. We identified our basin candle plus the big green candle. So we have our base and we have our bullish green moving the market up aggressively. We hit the top of the basin body candle to the lowest wick, right? That's what I just explained here. Lowest wick out of the two and the top of the basin candle, fully engulfing the basin candle. This is non-negotiable. An invalidation of the rule is a broken zone, which we did not get that. Once price breaks through your supply or demand zone, it is invalidated, completely invalidated here. And we also had volume confirming that is not just a key area, it is a demand zone. It cannot work without buyers. There's no buying volume. The probability of failing because there's low or to no buying volume is a lot greater. Volume confirms that market participants are still defending your demand zone. So now I want you guys to understand why it works. It's created by buying pressure. When massive buying occurs, like we just saw, it creates a demand zone. Price will likely move back to that zone hours after, days after, even months after, to finish the execution of the orders that are still there from the drastic move. These orders were left behind because there was too big of a squeeze too quick. Showing exactly what we saw here. We get a nice squeeze, we revisit it, we take some more orders down, and then we finally move up for another couple hundred points, and it just keeps on going, and it never comes back, right? We move thousands and thousands of points off of this double touch in here. I don't want you guys thinking that this is a do-all be-all. They will fail, of course, or else the market would just stay in a small range. You can't just buy in a supply or demand zone hoping for the best. You need to see actual buyers stepping in the tape into the market, volume increasing, and without any of this or confirmation of anything else, you are gambling just like anything else, and you're not trading. Of course, we're watching buyers, but we also have to watch sellers. Sellers should not increase inside of a demand zone. If selling pressure rises, buyers need to meet that pressure and or aggress off of it to hold that level for a bigger move up. If sellers overwhelm buyers at your demand zone, the zone is very likely to fail. The whole theory of this strategy is making a good risk to reward inside of your edge. You're not looking for 20 points off of a demand zone, you're going to be looking for a couple hundred points on NQ. Your risk to reward ratio on something like this with a good confluence should be extreme. So now for a supply zone, we're going to flip the theory. You need supply to increase and demand stays the same for a surplus to occur and move the price lower. If supply decreases and demand stays the same or higher, the price will definitely move higher. The same exact rules apply here for a demand zone that applies for a supply zone. It is exactly mirrored, and buyers and sellers should be swapped now. This is the most bare bone and simple strategy to use. You're just switching buyers to sellers. It's the same concept. So for a supply zone here, you're going to start up here. This is all-time highs, right? We are very fortunate right now that all-time highs just hit. We don't have to look back a year, 2 years, or 3 years to draw a zone, right? There's nothing behind this. This is all-time highs. So over here, we can mark it down, and we can get into it in more detail with a smaller zone. We're going to go down to a 3-hour here, a 2-hour, and we're going to keep on working our way down. Now in this 2-hour, this is a perfect example here. You can see a very big zone here. We have a 70-point zone on a 2-hour, which is perfectly fine. It is on the bigger side in my opinion, but we're also having a lot more volatility than usual. You can see a nice confluence where we get a drop, we come back into this supply zone, and then we drop again and we don't see the market for another 2,000 points. This is confirming that my supply zone is valid. Now, for something like this with 70 points, you can try to look inside of this zone on a smaller time frame to see a second possible entry if the market is going to come up higher. So for something like this, I'm going to keep on working my way down. And I'm going to keep on going to a 30-minute here, seeing what I could see different here. If I were to take this 30-minute zone in here, it will be slightly bigger. Already this zone is too big, so I'm not interested in it. So I'm going to go to a 15-minute, see if I see anything different. Now I can take the wick of this opening candle as a possible theory. This is almost a halfway point too. To see if we reject this middle point of this zone, which is slightly bigger. Same concept here. I'm going to be looking at these two areas for a supply zone now. And I'm going to go back all the way up in time frame to a 4-hour. And I'm going to see what I could see off of these levels. We have a decent 1-hour zone in here. Again, we're going to the highest wick and we're engulfing the body of the basing candle. The market rallied, we based, and then we dropped. I'm not doing this. I'm not doing this. We're getting the highest wick, and then we're engulfing the body of the basing candle here. This is our 1-hour supply zone. We're going to keep on going down in time frame to see if we can see anything different here. We have a 45-minute, which is slightly smaller in here. I'm going to see how big this zone is to see if I even want to make it smaller. This is a 52-point zone originally. I don't think I need to make it much smaller. We're going to go down to a 30-minute. Keep on checking our zones. A 30-minute is slightly bigger. I do not want to miss a move judging by this 1 hour to a 30-minute. So I'm just going to slightly pull it back. Again, this is a very, very ugly candle, and this is more advanced. So we're just going to keep it at this. We're taking the highest wick out of the two. I know it is very, very ugly. It's not as easy to see. And we're going to engulf the body of the basing candle. This is our new 30-minute supply zone. I'll be very upset with myself if the market ends up rallying off of this 30-minute supply when my 1 hour was right here. Right? If we get a big, big drop off of this 30-minute instead of the 1 hour, and I'm missing it by just 10 points when the market's going to move a couple hundred points, it's going to be very frustrating for me. So I'd rather take a bigger zone and wait for confirmation. We can see almost perfectly here, same concept. We have a rally, a base, and then a drop, right? Massive, massive drop in here. We have New York volume. Now I'm going to mark this down, the highest wick, and the body of the basing candle. This could be another 30-minute zone, but I'm going to go back up in time frame to make sure there's not a bigger zone or a higher time frame zone. 3 hour, 2 hour, 90. This 90 would be a little too big, so I'm going to go down to a 1 hour. 1 hour is the same thing. 45. The 30 is the nicest looking zone I can create here. This is my next 30-minute supply zone. Like I stated, you're taking the highest wick and you're engulfing the body of the basing candle. This is your basing candle. We have New York volume to confirm it, and those are our 3 supply zones at the top of all-time highs. Again, the same exact concept with demand. When massive selling occurs, it creates a supply zone. The price will likely move back to this level within hours, days, or even weeks to finish the execution of those institutional orders. Just like demand zones, supply zones will fail. You need sellers to actively step into the market. You need selling volume to increase inside of the supply. Without actual participants from those sellers inside of a supply zone, the zone has no strength. Same concept again in here. Buyers should not increase inside of a supply zone. If buying pressure increases, sellers need to match it or add to it to hold that level for the move down. If buyers overwhelm sellers, we will squeeze the supply zone just like the demand zone if sellers squeeze out buyers. So risk to reward here is everything, just like every other concept in the market. The supply and demand zones will help you manage your risk to reward and look for bigger trades. You have a defined entry and a defined exit, and a defined stop loss. A supply or demand zone should give you well over a 3-to-1 risk to reward ratio. Often it's much higher than this, but if you find yourself making zones and they are not that good of a risk to reward ratio, chances are you're doing something wrong. A supply zone is always going to be stronger in a bear market. They are higher quality setups, they're going to work more often, and vice versa with the demand zone. If you're in a bull market, like we currently are in now, a demand zone will always work better than a supply zone. The chances of it working are a lot higher. And to end this here, volume is needed, it is key. We're not looking for support and resistance zones where it can have no volume and just make a big wick and fall. We're looking for actual participants in the market. We're looking for the institutions, the banks, the big orders that are actually moving the market up and down. We're trying to go along with them and get a little piece of their food instead of going against them and fighting them. Anytime you try to fight the institutions, the banks, or the big orders, you will always get ran over. We're just trying to stay slightly behind them and pick up their scraps, taking a couple hundred points in the market, which is nothing for them, and it is everything for us. So a quick checklist. We're going to always scan from left to right. We're going to start on a higher time frame. We're going to identify the basing candle and the highest wick. We're going to draw the zone from the highest wick on a supply zone or the lowest wick on a demand zone, and we're going to engulf the basing candle. Once price breaks through the zone, it is now deemed invalid. We're going to now enter in a demand zone and try to exit in a supply zone, or vice versa. If you're trading futures and there's an increase in volume in Asia session or London and it's not New York, you can use that as a supply or demand zone. But trading stocks, it has to be during open market hours of New York session. So I hope you guys liked this quick video. I would appreciate a like, maybe even a comment if this was helpful. Let me know if you're coming in from YouTube, Top Step, or Wyze.trading. Do not forget to check out my community down below where I teach all of this. I teach risk management, psychology, everything that a trader needs from A through Z, all the way from how to read a chart to order flows and advanced tactics. Again, thank you for watching, and remember to stay wise.